Many professionals have seen a P&L, though very few know what to actually look for. In 5 minutes, you will. A P&L is not an accountant's report card. It's a navigation tool, and you are the intended user. The structure is straightforward. At the top, revenue, the total income your business has brought in. Below that, costs of goods sold, or COGS. These are the direct costs of delivering what you sold. For a consultancy, that might be contractor fees. For a product business, it may be materials and production. Revenue minus COGS gives you gross profit. That is how much you made before the lights on costs. Then come operating expenses, things like rent, salaries, marketing and software. Subtract those and you reach net profit, or the bottom line. 5 lines, 1 story. But knowing the labels is not the same as understanding what the document is telling you, and that distinction is where most people stop short. And here is that distinction that matters most. Net profit tells you whether the business made money this period. Gross profit margin tells you whether the underlying model has room to work at scale. Gross profit margin is simply your gross profit divided by revenue expressed as a percentage. If you bring in £200,000 in revenue and your COGS are £140,000, your gross margin is 30%. That 30% is what you have left to cover every overhead before you see a penny of profit. A healthy gross margin means the model can, in principle, scale. A thin one means you're fighting a structural problem, not just a cost problem. Net profit can look fine in a given quarter because you can cut a cost or had a one-off windfall. Gross margin is harder to flatter. It tells you whether the engine works, not just whether this particular journey was comfortable. Once you have the structure, read the relationships. If gross margin is healthy, but net profit is thin, the issue is in operating expenses. Look at whether your overheads are growing faster than your revenue, and that gap is where margin gets eaten. If gross margin itself is under pressure, the problem sits higher up. Your delivery costs are rising, your pricing is too low, or both. That is a model question, not a cost-cutting exercise. And here's one important caveat. A P&L reflects a chosen time period, and the accounting method matters. Cash-based accounting records income when cash arrives. Accrual-based records it when it's earned. The same business can show different numbers under each. A P&L also does not show your cash position. You can be profitable on paper and still run out of cash. So read the P&L, but do not read it alone. The rule of thumb is to start at the bottom and think upward. Net profit tells you the income. Gross margin tells you whether the model can ever work. And that's the question worth asking first. If that was of value, subscribe to the channel for one real business question answered every video. For the same clarity in writing, the website and newsletter is 5minutebusiness.com.